Data Points is Jonathan Dane. He's a founder and chief investment officer at Defiant Capital Group. Jonathan, thank you so much for joining us on the show today. And as we watch this market open, how are you advising your clients?
Yeah, I appreciate it. Thank you for having me. So in this market today, it's interesting. After yesterday's pullback, we're telling clients this is really typical for after a presidential election year. Typically, markets after a president is elected, whether it's a Democrat or Republican, they will rally. And so you see a great rally in November. It's historically the best month of the year. There is usually a pullback in December. What we're telling everybody is this is a great time now where if you had cash on the sidelines and you were looking to rebalance or redeploy, if you were looking to put some money to work, great opportunity right now. We're optimistic on the markets and we think you should be putting money to work.
So what were the most important points, Jonathan, that you heard from the Fed Chair Jerome Powell yesterday, both in the press conference and in that statement and economic projections?
When he was speaking yesterday, for us, it was a confirmation of what the markets have been saying. And that is, look, the incoming administration's policies are inflationary in nature. We've seen inflation come down, but it's still volatile. And so while everything seems to be trending in a direction of a soft landing, this also is an opportunity where we can slow down the pace of rate cuts and sit in a higher for longer rate environment. To us, that means that investors, it's not so much a negative, it's a great opportunity that the Fed sees a strong economy and they just want to make sure that all the pieces are in place for it to stay that way.
By how much do you think the market, specifically the S&P 500, can rise in 2025 on the expectation now that we will see fewer rate cuts?
We look at the market and we're optimistic on it. We think earnings have room to keep running. We think that if you look at the broad market right now, especially looking at, say, an equal weighted valuation versus the S&P, which is more tech heavy, there's actually room for multiples to keep going. There's room for earnings to go up with those multiples. And so while we don't think we're going to see another year like this where we're high 20s, 30%, we continue to think the stock market can outperform its historical trend at least over the next couple of years.
Interesting. And what's going to fuel that growth? Are there specific names or sectors, Jonathan, that you expect to outperform?
We absolutely think that, so one, strong economic momentum, the consumer continues to drive a lot of growth in the market. But if we look at it, so you can't not talk about the Mag 7, we think the Mag 7 still has room, but they're not going to run as fast. Instead, we look at the incoming administration's policies on energy, on infrastructure, AI and data centers. And so we look actually at the utility providers, we look at the infrastructure builders of this economy. We think there's a lot of opportunity there for them to actually run further.
Interesting. And in terms of what we see on the horizon for geopolitical risks, it sounds like obviously your outlook is very optimistic, Jonathan. But I do want to talk about some of the potential risks here that our viewers should know about.
Yeah, absolutely. I mean, there is so much geopolitical tension going on in the world right now that everything has to be looked at. I think you have to separate the two from what's going on in the world to how is it going to impact the US markets. And right now with all the tension, a lot of it isn't quite trickling over to the US markets yet. We definitely see a lot of volatility around energy, what could happen there. We think that especially the tariff issues is a big deal. And if we go tit for tat again, we ultimately think that it's going to hurt the consumer in the US. But what we've been telling clients is if you go back and you look at the original Trump administration's policies, they've always started at the extreme. Extreme tariffs, extreme move all manufacturing back to the US. And that's a great place to start your negotiations. But ultimately, at the end of the day, there has been some type of middle ground. And so we think that there's going to be a lot of knee-jerk reactions, a lot of volatility from it. But ultimately, things will stabilize a little bit and they won't be as bad as feared.
You know, we've been looking at the deal pipeline for a long time, Jonathan. Of course, the interest rate environment does impact that to some extent. When it comes to what we're seeing in the private markets, how might that move over into the public markets in 2025?
Yeah, M&A activity, especially private to public markets, has been very weak in 24. We are optimistic that, I mean, if you look at the financial sector right now, there is a reason that banks have rallied. There is a reason that people are optimistic, and that's because there's potentially less regulation right now. So we're very optimistic that, one, banks, even if rates stay higher for longer, there's a great opportunity for them to get their M&A pipeline back up. There's a great opportunity for more IPOs next year. We really think now is an opportunity for a lot of companies that have been staying private for longer to IPO and see a big push into that market.
All right, we will be watching very closely here at the New York Stock Exchange. Jonathan Dane, founder and chief investment officer at Defiant Capital Group. Jonathan, thank you.